there is a lot of evidence here looking at past recessions for multifamily resilience during an inflationary time. And we're not even getting to the fact that after a recession, we typically see a significant amount of rent growth that typically washes out the losses during that recessionary period. So
Yeah.
I think really illustrates it now.
And if you look at the chart for the real housing price rent growth and real rent growth after the 2000s, you can see that the after the year, I think now I've got to have to zoom in here. After around 2002, there were only two moments where rents went down, and that was between 2008 and 2010, during
Hmm.
kind of in the wake of the great housing crisis, and then during the pandemic. After that, it has always been there's been consistent rent growth, and that's kind of like a 20-year period. And you have, and even those moments where rent growth did dip down, they didn't dip down very much. And you
Yeah.
can look at the housing price growth really dip down during those years. So what we see is a more moderate effect of any kind of price fluctuation in the rental market versus the nominal housing price growth.
Yeah, I think, yeah, man, I think this really illustrates how less volatile the rental market is versus the single family home market itself. I mean,
Yeah.
very stable. Though things don't always go up, so obviously there's some declines here and there, but they're they're kind of blips on the radar in context of
Yeah.
the last couple decades. That's for sure.
Now, so that was kind of the past, and that was the kind of the context that we're going into it. And I still think that it holds true for this potential recession or actual recession, depends on kind of who's defining it. But they do single out five factors that are that can kind of guide us through how the multifamily market might fare compared to the previous recessions. One is a slower rate of new construction, which we've seen, and really we are still seeing kind of play out.
Hmm.
It still remains to be seen. There were some predictions say that we might have 450,000 new units by the end of this year.
That's some
Some
500. Yeah.
Yeah, some say 500, but it all depends on how quickly things can get built and how expensive they are, and whether these supply jams and materials bottlenecks and labor shortages, whether that has a more meaningful effect on construction than not. So the second one is a transfer of demand to the multifamily market, which kind of has to do with a price to rent ratio, in that if housing prices are higher, such as a lot of people have talked about, the mortgage rates, making it harder for people to buy a home. Are those going to become renters? Now, they also say, and I think that this is a good point, there could be aftershocks there where things could swing back very quickly. You've seen how, we just took a look at these charts, how volatile the housing price market is. And so that could swing back. And but I think, though, right now, if you're looking at these charts, the price of a home is so much more than the price for rentals. I think that we have more room for rent growth. I think that it is also a big sign that if multifamily does well during a recession, just in general, we have a little bit more cushion because there is so much room between how high housing prices are right now and how high rents are.
Yeah, I mean, look at this chart of this is existing single family home prices to multifamily market rent ratio. Kind of the higher that it goes, the bigger gap between what it would cost you to buy a home versus what it costs to rent. And what we were most affordable, or sorry, the least affordable kind of in the 2011 range. That's because prices of single family homes had declined so much. So buying a home made a lot of sense because you could pick up a house for on the cheap. It's just the absolute opposite
Yeah.
scenario right now, where we're basically back at the levels in 2005 where housing is so expensive and renting makes a lot more sense. But to your point, Matt, and to the point that Moody's is making, the risk there is that if at some point housing will get cheap again, if that happens, there's so many potential buyers that are on the sidelines, many of which are just waiting for that opportunity.
Yeah.
Now, depending on who you speak to, people are saying, well, they're never going to really see the opportunity that they really want. And even if prices decline, you're still looking at if interest rates are still high, which that's a question for how long they'll be at elevated levels. But can you still afford the monthly payments? Can you still qualify? And with so many buyers on the sidelines, any any material decline in pricing, or how quickly will buyers immediately jump in, ready to go? They kind of, which acts as a floor to the
Mhm.
housing market, because we have to remember that so many millennials are hunting for their first home right now. They're at peak home buying age, and they're having families and having kids, and they want to buy a house.
Yeah.
And then the other thing I think about is how many of those individuals will eventually just become, renters, for life, because, they've just missed out on that opportunity, and they're going to kick the can down the road so far that they're going to be a renter for at least the next, 5 or 10 years. And maybe they'll never buy a home. Yet
Yeah.
to be seen.
Yeah, it is crazy. I mean, just looking at this chart, we are houses to buy a home. It's almost as expensive as it ever has been, and even in a very volatile situation, the home prices have a long time to fall. It would be almost impossible to cut it down in 1 quarter or 1 year even.
Yeah.
So there's some cushion there, and I think that means maybe a little bit less risk, that we would see a downside. And if we do see one, we'll see it coming a long time in advance.
Hmm. Agreed.